Hi there. Learn how beneficiary designations may influence inheritance tax outcomes across multiple generations.
Imagine spending your entire life, and maybe even the lives of your parents and grandparents before you, building a successful family farm, only to wake up one day and realize the government is about to claim 20% of your legacy. Well, hello there, and welcome to This Explainer. I'm absolutely thrilled to be with you today on behalf of My Tax Accountant, or MTA as we're known, the go-to UK firm for making sure you stay completely tax compliant while actively protecting your hard-earned wealth. Today, we're going to walk step by step through a massive legislative shift, structuring agricultural land transfers to qualify for maximum inheritance tax relief in 2026 in the UK. If you're a UK farmer or a landowner with a multi-generational family farm, you want to pay close attention because this explainer is tailored specifically for you. We're going to treat this just like a friendly professional consultation, taking all these complex rules and breaking them down into a really clear, structured roadmap.
Right, let's kick things off with a number that is quite literally sending shockwaves through the UK farmer community right now. £2.5 million. Historically, as you probably know, qualifying agricultural and business property enjoyed 100% relief from inheritance tax, completely regardless of its total value. But from the 6th of April 2026, that 100% relief is strictly capped at £2.5 million per person. Anything above that threshold, it's only going to get 50% relief. Make no mistake, this isn't just some minor policy tweak, it's a fundamental rewrite of generational wealth transfer in the UK. For a farm that's been in the family for 4 generations, this isn't just numbers on a spreadsheet. It's a direct, imminent threat to their livelihood and operational survival.
Which brings us to a really uncomfortable, but absolutely crucial question. Will your family have to sell the farm just to pay HMRC? Because that 50% relief on anything over the £2.5 million cap actually translates to an effective 20% tax rate on the excess value. For so many of our land-rich but cash-poor farming families, an unexpected tax bill of hundreds of thousands of pounds could frankly threaten the very legacy they've spent generations building.
Now, take a breath, because helping you avoid that is exactly why we're here today. Here's our structured roadmap to secure your estate. We'll cover the 2026 tax shock, how to calculate your farm's exposure, and then we'll dive into 3 practical steps: lifetime gifting, skipping a generation, and post-death deeds. Finally, we'll wrap up with securing your farm's future. Okay, let's dive into Section 1, the 2026 tax shock and these big agricultural tax changes.
So, the real danger here lies in the stark contrast between the old rules and the new reality. Pre-April 2026, if you had a qualifying working farm, the value was uncapped. You got 100% agricultural property relief, or APR, on the whole lot. But post-April 2026, bam, we hit that hard £2.5 million ceiling. Combine this with the fact that the standard nil rate bands, that basic £325,000 threshold, are completely frozen until April 2031, and we're seeing some really aggressive fiscal drag. Basically, as inflation artificially inflates the paper value of your land, the tax-free thresholds stand completely still. You haven't gained a single penny of actual cash, but HMRC drags you into a massive tax bracket anyway. It's a trap that's going to catch more and more families every single year.
Moving on to Section 2, calculating your farm's exposure to this risk.
Let's make this crystal clear with a practical, everyday scenario. Imagine a typical British farming family with an estate sitting at £4.5 million. Under the old rules, assuming it all qualified for APR, the tax bill would be zero, zilch. Now, under the new rules, the first $2.5 million is fully sheltered by the new cap, so that's your 100% relief sorted. But that leaves a £2 million excess. That $2 million only gets 50% relief, which leaves £1 million fully exposed to the standard 40% inheritance tax rate. That means an effective tax rate of 20% on the excess, resulting in a sudden, massive £400,000 tax bill. Finding 400 grand in liquid cash for a working farm, that's incredibly difficult. If a $400,000 tax bill landed on your doorstep tomorrow, honestly, would your farm survive without selling off acres?
So, what do we do? How do we legally dismantle this exposure? Well, as tax professionals, we generally look at 3 structured avenues. Step 1 is lifetime gifting. Step 2 is generation skipping. And Step 3 is an emergency safety net, deeds of variation. Let's explore each one of these just as if we were sitting across the desk from one another at the MTA office.
Let's jump straight into Step 1, lifetime gifting. This is your proactive strategy.
You might already be familiar with the famous 7-year rule, which governs what we call potentially exempt transfers, or PETs. If you gift a parcel of land to your successors today, let's call that year 0, It still counts as part of your taxable estate. But if you survive for 3 years, taper relief begins to chip away at that potential tax burden. And if you survive a full 7 years, that gifted land falls completely outside your taxable estate. Here's a professional tip for you. Act early. Because the new £2.5 million cap is per person and actually refreshes every 7 years, early lifetime gifting effectively restarts the clock. It allows you to pass down massive parcels of land over a few decades entirely tax-free before those 2026 rules can ever bite you.
And hey, while you're structuring those larger land transfers, definitely do not ignore the supplementary exemptions you can stack right alongside them. You've got an annual exemption of £3,000 per year, and you can even carry that forward 1 year if you didn't use it. You've also got the spousal exemption. Transfers between UK-domiciled spouses are completely free of inheritance tax, meaning a married couple can effectively double their 100% relief cap to a cool £5 million. Finally, there's gifts out of surplus income. If you're regularly gifting money from your income, maybe paying a grandchild's school fees, and it doesn't negatively affect your standard of living, it is immediately exempt. There is literally no 7-year risk whatsoever with that one.
Right. On to step 2. Skipping a generation to avoid double taxation. Here is a crucial point. If your children are already financially secure, maybe they own their own property or have large pensions, leaving that £4.5 million farm to them simply inflates their estate. It basically guarantees a massive tax bill when they eventually pass it down to your grandchildren. It's a classic double taxation trap. Generation skipping directly to your grandchildren avoids taxing that same asset twice. Plus, it neatly bypasses Section 629 parental settlement rules, ensuring the income isn't just taxed right back on the parents. And here's a did you know insight for you. From April 2027, unused defined contribution pension pots are going to be dragged into the taxable estate for the very first time. That means your children's estates are about to get much larger on paper, making generation skipping even more vital today than it was yesterday.
Now, obviously, you probably don't want to hand over the deeds of a working farm to a 5-year-old, right? And that is exactly where trusts come in. A bare trust is fairly transparent to HMRC. The beneficiary is taxed directly based on their own personal allowances. But the catch is, they get absolute entitlement to the assets the second they hit 18 in England and Wales. On the flip side, a discretionary trust gives the trustees ultimate control over who gets what and when, keeping the farm protected long-term. Now, it does fall under the relevant property regime, which means there's a maximum 6% charge every 10 years. But honestly, that is an incredibly small price to pay for ironclad protection against things like a beneficiary's divorce or creditors, all while minimizing the immediate tax burden on the grandkids.
Which brings us to step 3, post-death deeds. Think of this as your emergency safety net.
Sometimes, despite our best intentions, a will is outdated, or a family suddenly finds themselves completely exposed to that new 2026 cap unexpectedly. If that happens, there is an emergency fallback called a deed of variation. This actually allows the beneficiaries to retroactively rewrite the will for tax purposes. But you have to be incredibly mindful of the timeline here. Month 0 is the date of death. Realistically, you want unanimous agreement among all the affected beneficiaries by month 12. Why the rush? Because month 24, exactly 2 years after the date of death, is the absolute, strict legal deadline. Miss that 24-month window, and honestly, the opportunity to restructure the tax is gone forever.
But if you use it in time, a deed of variation is incredibly powerful. It allows a financially secure child to just redirect their inheritance straight to their own kids, skipping a generation just like we talked about, without it being classed as a potentially exempt transfer from them. It allows the family to proactively place agricultural property into a trust to preserve that vital relief. Imagine a family avoiding years of bitter, expensive court battles simply by coming together around a table within that 24-month window to reshape their legacy collaboratively. It maintains family harmony and avoids draining the estate with astronomical legal fees.
Finally, Section 6, Securing Your Farm. Let's wrap this up with some final thoughts.
If you only take away one single thing from our time together today, please let it be this quote: "The planning is what protects the estate, not the hoping." Without active, structured planning before April 2026, the family farm is pretty much at the mercy of HMRC and these new legislative caps. Hoping the rules will suddenly change back, or hoping your estate somehow won't be affected, that is not a strategy. Structuring your transfers proactively is literally the only way forward.
Now, just before we sign off, I do need to share our standard regulatory disclaimer.
This explainer is for educational purposes only and does not constitute formal financial, legal, or tax advice. Tax rules here in the UK are incredibly complex, and outcomes depend heavily on your individual circumstances and how all these different rules interact. You should always seek professional, tailored advice before making any financial decisions.
And that is exactly where we come in. If you want to secure your agricultural legacy and make absolutely sure your estate is efficiently structured ahead of these massive 2026 changes, reach out to My Tax Accountant today. You can give our team of experts a ring directly on 0208-570-8531. You can drop us an email at info@mytaxaccountant.co.uk or just visit us online at www.mytaxaccountant.co.uk. We are ready to help you build a totally bespoke plan for your family's future. Thank you so much for joining me today. Don't forget to subscribe to our channel to stay updated with all our latest tax explainers, and I'll leave you with this one thought. When April 2026 finally arrives, will your legacy be a flourishing family farm or a massive tax windfall for HMRC? The choice and the planning starts today.